A few weeks ago, a client sat across from me. Her father had just passed away, and under his will, everything went straight to her, including a share meant one day for her teenage kids. She asked me a very simple question during that appointment. If something happens to me now, does this money automatically go to my children? And the honest answer was not in the way that she thought it would. And by the time we'd worked through it, she had lost thousands of dollars in tax that a slightly different will could have avoided entirely. So that is what we are going to talk about today. Testamentary trusts. One of the most underused, most misunderstood tools in estate planning. And the question your accountant most likely wishes you had asked before it was too late to ask them. My name is Sue Ellison-Whyte, and I'm the principal solicitor at Ellison-Whyte Law. We are a boutique law firm based on the Mornington Peninsula. We offer fixed fee services, innovative practices, and limited scope work. This is the podcast Unsolicitor's Opinion. Real law, plain English, and no jargon. Today's episode is about testamentary trusts. What are they? Why do they exist? And more importantly, who actually needs one? Do you need one? Because it isn't for everyone. And for the people who do need it, it can be the difference between protecting a family's wealth for multiple generations or watching it evaporate in tax, divorce, or a bad decision made by someone too young to make it. So what is a testamentary trust? Let's start with the name. Because it puts people off. Testamentary simply means it's created by a will. A testamentary trust is a trust that doesn't exist while you're alive. It's written into your will, sitting dormant, and only springs into existence when you die. And only for the assets that you've directed into the trust. Compare that to a family trust that you might set up during your lifetime that exists now, has its own tax file number, and it needs decisions made about it every year, whether you like it or not. A testamentary trust is very different to that. It costs nothing to have it sitting in your will, and if it's never triggered, and if your executor and beneficiaries decide that the assets in the estate should just be distributed outright, it's simply never used. No ongoing cost, no ongoing complexity, until the day it's actually needed. Structurally, think of it as an option that you're building into your estate plan now, that your family can choose to exercise later when the circumstances of the day make it worthwhile, usually with appropriate tax advice. So why do people actually use testamentary trusts, and what are they for? There are two main reasons why people build testamentary trusts into their will. The first is asset protection, and the second is for tax purposes. So with regard to asset protection, if you leave money directly to a beneficiary, obviously it becomes their asset. That means it's exposed to whatever's going on in their life at the time. A business that fails, a relationship that ends, or a creditor with a claim against that beneficiary. Money held in a properly structured testamentary trust, by contrast, sits inside the trust rather than in the beneficiary's own name, which makes it considerably harder for a former partner, the trustee of a bankruptcy, or a creditor to reach those funds. I do want to be careful though. A testamentary trust is not a guaranteed shield to every family law or bankruptcy scenario. Courts look at how the trust is actually controlled and used, and not just how it's labelled. But structured well and left alone rather than treated as that beneficiary's personal bank account, it materially strengthens the protection available under the trust. The second reason is tax, and this is one that surprises a lot of people. Ordinarily, if a minor child receives investment income, It's taxed at punitive rates specifically designed to stop parents from shifting income to children to dodge tax. We're talking rates that can apply from the very first dollar. Income distributed to a minor from a properly established testamentary trust, however, is generally treated differently as what the tax office calls accepted trust income, and can be taxed at ordinary adult rates, including access to the tax-free threshold. So for a family with grandchildren who are still minors, or parents with minor children, that can make a huge difference distributed sensibly each year and can save you thousands of dollars annually, which compounds over the years it's used as a distribution mechanism to those beneficiaries. So, of course, I'll flag honestly though, I'm giving you the shape of the rule and not the exact numbers. Tax thresholds and ATO guidance do move. So if you think that this might be relevant to your estate planning needs and your family circumstances, that's a conversation for your accountant and your lawyer together, working together from this year's figures. So what's changing in terms of tax? Because we've all heard about it. The 2026 trust tax reforms now, if you've been anywhere near a family trust conversation this year, you've probably heard something about the big changes coming to how trusts are taxed in Australia. I want to address this directly because it's caused a lot of confusion for people, and it actually matters in relation to what we're talking about, testamentary trusts. In May 2026 federal budget, the government announced a new 30% minimum tax on discretionary trusts due to start from the 1st of July 2028. In plain English, trustees of discretionary trusts would pay tax at a minimum rate of 30% on their trust income, with individual beneficiaries getting a credit for that tax against what they otherwise would be owed. I want to be really clear about two things. First, this is not the law yet. As I record this, it's still at the announcement and consultation stage. Treasury has been taking submissions on how it would actually work, and there's a real path between the announced in the budget and sitting in the Tax Act. So things can and do change in that regard, and no doubt we will do a follow-up podcast in the future regarding this. Second, this is the part that matters for today's topic in particular. Testamentary trusts are treated differently. Based on what's been announced, testamentary trusts that already exist at the time of the budget announcement are specifically carved out of this new measure. That's the trusts we've been talking about all episode, the ones written in a will, okay? So if, again, this is put into the legislation as announced, then that may be the case. However, we can't 100% guarantee that at this stage, because it's not in the Act yet. So it's something that we'll keep abreast of and we'll update accordingly in the future. So if you already have a testamentary trust in place or you're building one into your will now, this proposed change is unlikely to be something that catches you out. But if your family also uses a family trust set up during your lifetime, being a discretionary family trust, this is the exact kind of reform that changes the maths on how that structure is used, and it's worth a conversation with your accountant well before 2028, not after. So I'll keep flagging this one in the future as it moves through the process, because I'd rather you hear about it here first than be caught off guard by it later. So who actually needs a testamentary trust? And what are they actually for? In my experience, there are a few situations or clients' circumstances that come up again and again where a testamentary trust is really helpful. So parents or grandparents leaving money to grandchildren or children who are still minors or likely to be minors at the time that the inheritance flows through. Blended families, where you want to provide for a spouse during their lifetime, but ultimately protect the capital of the estate for your own children. Anyone leaving an inheritance to a beneficiary going through a real risk of a relationship separation or divorce. Business owners or professionals whose beneficiaries carry higher personal or commercial risk. So if you've got like children who run businesses, and families with a beneficiary who have vulnerabilities around money. So they could have a disability, they could have an addiction, it may be their age that they're just vulnerable, or simply a really poor track record with financial decisions. So if none of that applies to your situation, you may not need a testamentary trust at all. And I'd rather tell you that now honestly than try and sell you something you don't need. Part of a good estate planning is knowing what to leave out, not just what to add to your will. So here's the thing about testamentary trusts. They cost you nothing to build into your will today other than the fixed fee. And they can save your family an enormous amount of money tomorrow in tax and in asset protection and also in certainty. So if you've got a will that's more than a few years old, or you've never actually had a will and you've never asked these questions and you think that this might apply to your situation and your family circumstances, then we recommend you booking in to your local solicitor. If you're in our area, book in with us and have that conversation to review your will, or if you don't have a will, to review your estate planning needs, and we can help you build a pathway forward so that you get the best out of your estate planning. I have seen time and time again people get absolutely devastated because there's no will in place whatsoever. They may be in blended families and mum and dad never thought about the complexity that they were leaving behind and the mess that they were leaving behind. I've had numerous clients come in and make their wills after they have watched their entire family get ripped apart to shreds, never again to have family dinner on Sunday or Christmas, because the testator, the person leaving the estate, never prepared a will or left people out that should have been catered to in a different way. So in that regard, when I think about your will and your estate planning, this isn't a cost to you right now. It's an investment into the future of your family in terms of protecting your asset or your wealth creation into future generations. It's something that is really important, and it needs to be put in place if you want to make sure that your future generations are protected in the right way. So when I think of it as an absolute no-brainer. It's something that you don't want to leave to chance, because unless you've had advice on what happens when you leave it to chance, you may have a very real misconception of where you think your estate will go when you die, if you've not left a will. So my name is Sue Ellison-Whyte from Ellison-Whyte Law on the Mornington Peninsula. If you need assistance with your estate planning, then feel free to drop us a line. You can book all of your appointments on our website through our online booking portal. We have an online intake form where you can provide your initial instructions directly on the front page of our website, and then book in for an initial appointment, and we'll go through those with you. All of our fees are also listed on our website, so We do try and create transparency around certainty of cost, around certainty of experience with our clients. We'd love to hear from you. So you've been listening to the Unsolicitor's Opinion, episode 2 of the 2026-27 year, and catch you next time.